So Nicholas Bornos of Capital Link, and I'd like to welcome you to another very interesting panel in today's forum. The energy transportation in the Jones Act space is one of the most active trades, and we are delighted to have with us a top panel. I will let Ben Nolan, the head of Maritime Research at Stifel, introduce our esteemed panelists. And I'd like to thank Stifel for sponsoring the event and helping. And Ben, the floor is over to you. And thank you to Sam, Greg, and Daniel. And thank you very much to all of you.
Great. Well, we don't have very much time, and I don't want to take much. So why don't we do this? We'll go around the horn, and each of you 30 seconds on your company, just so that you can do a better job of explaining who you are than I can. So Sam, we'll start with you.
Thanks, Ben. I'm Sam Norton. I'm the president and CEO of Overseas Shipholding Group. We're a New York Stock Exchange listed tanker owner-operator, primarily working in the Jones Act. We have mostly tankers trade in the Jones Act. We do have a couple of ships that trade under U.S. flag overseas. And we have a couple niche businesses, including moving Jones Act crude oil from Alaska, some lightering business in the Delaware Bay, and shuttle tankers that run in the Gulf of Mexico off the FPSO platforms there. So prominently Jones Act, all U.S. flag, based in Tampa. Dan?
Thanks, Sam. Thanks, Ben. Dan Thorogood, CEO and president of Seabulk. We own and operate U.S. flag tankers, both on time charter and in contract of affreightment business. We also have harbor tugs, and we provide third-party vessel management. Greg?
Good morning. Glad to join the panel. My name is Greg Binion. I'm executive chairman of OXO Marine. OXO is a private equity firm based in Grand Rapids, Michigan, that owns two Jones Act companies. One operates in the Great Lakes, Andre, moving asphalt, cement, and other construction materials in the Great Lakes. And then MG Transport, which for 50 years has served the lower Mississippi River, predominantly moving petroleum coke from complex refiners in the region to export terminals. And Ben, back to you.
All right, great. Well, so we'll start with the macro. It has been a rough couple of years in just about all of these segments that we're talking about here. It seems like oil demand is recovering. We'll talk about supply in a little bit, so I don't want to get sidetracked, but we'll just go around the horn here. Have we reached the tipping point? Is it all up from here, at least for a while, or are there more, stumbling blocks along the way, do you think? We'll go reverse order. We'll start with you, Greg. Your business is a little bit different than the other guys. How are you feeling about things?
It is different, but we're keen observers of the space. And, I've been in this business for a long time. First started riding towboats when I was 14 years old. And I guess my general comment is that this is a deeply cyclical market with capital intensive, long-lived assets. And as a result of the combination of those, it doesn't matter if it's the marine transportation space or other industries, is that there's typically periods of under and over investment. And when things get slow like they have been, typically there's periods of underinvestment, which cause price appreciation, tightness in the marketplace, and then ultimately a response by owners to add additional capacity, which then creates a down cycle. So, I think that is it all up from here? My experience is that I wish I could say yes. Unfortunately, I think that that those of us who have been in the business a long time have experienced cycles and expect to have further cycles in the future, and really then construct our business such that we have flexibility during those cycles as it results to cost levers and flexibility during the down cycles, and the ability to add incremental capacity at little cost and really get the operational efficiency out of our business during the up cycles.
I can, I guess, build off that a little bit. I'll focus on a subset of demand that's critical to the Jones Act tanker space, which is the Florida market. I'll leave the other more difficult pieces for Sam. But the Florida market obviously had the headwinds you'd expect through the pandemic. And we have certainly seen with the indicators we review a continuing uptick in demand, a very strong season. The driving season is during the cooler months in Florida. And so we've seen demand ramp up and stay up, which is positive. Obviously, there's some incremental factors, not just sort of a return to normality, but there is ongoing migration southwards with people more able to work remotely or looking for lower tax homes for the long term. We certainly see a tailwind overall in terms of Florida activity and related consumption of gasoline, jet, and diesel.
So I'll just try and sort of jump on the macro picture there. I mean, just a quick picture. 2020 saw tremendous demand destruction of transportation fuels, as you would expect. At what point transportation fuels across the United States were down as much as 40%. The refining industry reacted to that, but not nearly quickly or substantially enough. So you saw a tremendous build of inventories between the summer of 2020 and 2021. And we've really seen those inventories now being drawn down as demand has recovered across 2021 to where, kind of hit your point, Ben, inventories are at or below their 5-year averages. Demand levels in gasoline are back up to pre-2000 or 2019 levels, pre-COVID levels. Diesel has been healthy all along, and really the only missing ingredient has been jet fuel. And we're pretty optimistic that jet fuel is also coming back pretty strong. The jet fuel that's missing is kind of in the international jet travel. And with the retreat of Omicron, and looks like Europe and other places are opening up, most of the stuff that we look at sees jet fuel demand continue to rise across the second and third quarter. So that's all very supportive. Low inventory levels, increased demand, refineries starting to push up their utilization rates up into the upper 80s, low 90s. We think that sets up for a pretty healthy market across the next couple of quarters. And I would agree with Greg. It's to your disadvantage to try and predict that things only go in one direction, because stuff happens. You get pandemics, wars, changes of law, all these things happen. And I agree with Greg that the singular skill set that we all try and apply is our ability to adapt to changing circumstances and being able to try and to reorganize our assets, reorganize our approach to how we use those assets based on the circumstances as they come. I do think this year looks pretty positive, but all up forever, that would be unusual.
Then you meet.
Yeah, there it was. I had said, and it was very, very clever of me, that impossible was probably the word that you were looking for there. But let's stay on demand for a second, though, because consumption's rising certainly, and hopefully jet fuel, domestic jet fuel's pretty good, but international as it picks up should help out as well. That said, the landscape has changed a bit. Refineries have closed in some areas or are changing their feedstock mixes in certain areas. Consumption patterns are changing in parts of the country. And there's a lot to unravel there. And maybe some of the things that we can hit on, and if I miss any, then we'll, you please feel free to bring them up. But things like renewable diesel, right? That is a big thing in parts of the country and not so much in other parts. You've had, again, refinery closures in various spots, the West Coast, the East Coast, even to some extent in the Gulf Coast. How does all of that play in, and where does the international market interact with all of that? Even still, you look at all of the other green initiatives. I mean, these things seems like right now are not doing too much to take underlying demand, but ultimately, we'll see, right? So there's a lot of things that are different than they were probably even just 2 years ago. From a demand perspective, how does that play itself out for you guys, do you think?
Maybe I can jump in on that if it's appropriate. The single largest shift in the kind of demand for the tanker, the blue water tanker sector that we've seen in the last year or two has been the emergence of renewable diesel trade from the Gulf Coast refineries that are now engaged in renewable diesel production, with the primary market being California, where the low carbon fuel credits offer incentives for that diesel to be consumed there. And California, of course, is a large market. That was never a market in the past. So you see a Jones Act vessel go from the Gulf Coast to the West Coast was usually a positioning voyage. If you were going out to try and take care of the West Coast distribution market, or occasionally there might be an arbitrage that would open that up, but it really wasn't a constant move that we would see. Renewable diesel has changed that. There are, to my knowledge, at least 3 full-time Jones Act tankers that are now on longer-term charters, moving renewable diesel from the Mississippi Delta to California, and production of that renewable diesel is slated based on committed expansion projects over the next 2 years to increase still further, and probably getting to a level of 100 to 120,000 barrels per day of renewable diesel coming out of the Gulf Coast by the end of 2024. That's all new demand for Jones Act, and as long as California is the primary market and still has that low carbon fuel credits, that looks really interesting to us. And we see that as a strong tailwind for supporting what we think in any case is going to be a tightening market for the Jones Act in its conventional trades, moving product across the Gulf of Mexico into predominantly Florida, as Dan said, but also there's a distribution trade up and down the West Coast that takes ATVs and Jones Act tankers to connect the refining centers on the West Coast with the consumption centers. So that market has been hurt by COVID. It seems to be recovering and getting healthy again. And as we move forward, layering on top of that, new demand for renewable diesel is something that we find very encouraging.
Yeah, and I'll just add to Sam's comments on the East Coast. I mean, going into COVID, you had the Philadelphia Energy Solutions refinery shutting down, but that obviously was matched with a fall off in demand, and you're now seeing that Northeast demand component come back, and starting to see less traditional moves that are indeed longer haul for a blue water vessel, tanker or large ATB from the Gulf up to the Northeast, and that bodes well for ton miles and thus sort of overall demand. And hopefully there's a strong season ahead of us, and people are out and about in the New England, north of the Carolinas session, and that would be very positive for the trade lane.
And Greg, any Great Lakes or Brownwater dynamics that you think are a little different than maybe they used to be?
Well, I think, clearly in an environment of rising energy prices, the component of delivered cost to the customer that makes up the freight piece shrinks on a percentage basis as fuel prices go up. So what does that mean for us as transporters? It means that at the margin, it's there's more potential for longer trips that otherwise wouldn't be there, because the value of the cargo compels it to be so. And sometimes it's driven by difference in sulfur specs, or, in the case you were talking about taking Jones Act vessels to the West Coast for that trade, those kinds of things, whether it's market-based or whether it's policy-based, and we're seeing a little bit of both of those things happening at the same time. I think it will compel longer trips, which consumes more equipment days, which ultimately is really good for the space.
And this is maybe an unfair question because we haven't talked about it in advance, and gosh, who knows, but it's so topical that I can't help myself. If crazy stuff's going on in Russia, you guys have any prognostications as to what that might mean, if anything, for some of the domestic markets here?
Look, again,
Go ahead,
you want me to jump in on that, Dan? I'm happy to punt to you.
Brave enough to take it.
I'll just say one thing quickly, which is I think even before what we're seeing unfold in the last 24 hours, you had a fairly significant energy squeeze in Western Europe, and so less gasoline moving from the typical Rotterdam refineries into New York Harbor, and so that obviously needed to be replaced, and the natural way to replace that supply was actually from U.S. refineries, which remain world class, and obviously a Jones Act tanker or large ATB is the way to get that done. So I think even before what's sadly unfolding in front of us today happened, you already saw a squeeze where some of the supply channels were constrained. I assume they'll become further constrained at this point.
Because it's also hard to my experience when there have been sort of hostilities around the world in the last 20 or 30 years, the immediate reaction is oil price goes up very sharply. And then typically you see as things sort of settle out, the markets adjust and the oil price comes back down. I'm not saying that that's going to happen this time. I agree with Dan's comment, said energy generally around the world, and particularly in Europe, has been tight. And that alters the refining economics or the competitive economics of European refineries versus the United States in a very favorable way for the United States. And you're also seeing in the crude oil markets today, the Brent WTI spread is widened out. It was out like $7 this morning. That changes decisions for the refineries and the ones that are remaining, Monroe and PBF on the East Coast up in Delaware Bay. They're starting to look around to bring some crude oil domestically, either as a hedge against the possibility that Russian crude is not going to be available, or just simply because the economics are, on the forward curve, they're looking pretty compelling. Even moving, to Dan's point, moving long haul crude long haul for the Jones Act up to Delaware Bay. It has for the last 2 years not been competitive, and as of this morning, it looks pretty competitive. And so we may see some of that. I think I looked at this morning because I was just curious. Russian energy imports into the United States, that's crude and products combined, have been on a steady rise for the last 5-6 years, and hit a peak of as much as 25 million barrels a month. I think 26 million barrels a month in May. That's come off a bit since then, but that's still significant quantities of energy that's coming from Russia into the United States. I think a lot of that is crude oil going into the East Coast refineries. What we've read, and I saw an article in Reuters this morning, the sense of sanctions being applied to energy is that's not going to be high on the list because of the disruptive potential that blocking energy would have on the global economy. But that's still a lot of product and crude oil that's coming out of Russia that's coming into the United States that would create disruption if it was interrupted. So it's something that certainly we're watching very carefully, and indications today are, so are a lot of other people. They're starting to take decisions and make moves to protect themselves against the potential for that being disrupted.
Yeah, and I would agree with all those comments. I think the fact of the matter is that regardless of the cause of the disruption, is that it causes people to focus on security of, in this case, energy security. And I think as a nation, we may have lost focus over that over the last couple of years, and maybe that's starting to come back into the bullseye. And then also disruptive forces, whether caused by Mother Nature or Vladimir Putin, they tend to lengthen supply chains again, causing more unit days to be consumed, and generally, constructive for our space.
Right. So maybe there is a correlation here. I know, Sam, you guys are, it's not Jones Act, but it is U.S. flag, and many people don't know the difference. And I think even Dan, you guys do some MSP stuff. Since this is a Jones Act and U.S. flag panel, in fact, I can't help myself. I saw yesterday or the day before there was a Tradewinds article where it was talking about the Jones Act, and it showed it a internationally owned U.S. flagged asset. I was like, oh, it's just even the experts don't get it. But nonetheless, can we talk just for a little bit about sort of where you're seeing the the U.S. flag tanker business shaping out, and maybe if there are any implications about all of this geopolitical craziness on that part of the market.
You know, Dan, why don't take tankers? You can take other non-tankers because you're involved in both sectors. But there's a really important development on the tanker side when it comes to internationally trading U.S. flag vessels. Again, the singular difference is internationally trading U.S. flag vessels do not have to be constructed in the United States, but they're still manned and owned by U.S. persons. At least the manning has to be U.S. manning. The ownership can be through U.S. subsidiaries of foreign companies. So that's the way that they're structured. There are today roughly, I think the number is 87 or so international trading U.S. flag vessels. The vast majority of those are in the Maritime Security Program, which Dan can talk a little bit more about. And then there are the balance of them are really on time charter, either to the Military Sea Lift Command or to other government agencies to cover government needs in international transport. In that mix today, there's legislation that has been that's been passed and funding has been approved to expand the Maritime Security Program to include kind of a division of the Maritime Security Program, which is called the Tanker Security Program, with the intent to expand the U.S. flag international trading tanker fleet by initially 10 vessels and potentially more going into the future. There is a stipend that's provided to help offset some of the higher costs of running an U.S. flag vessel internationally. And there's also access to government-directed cargoes, which help to make the economic case for doing that. And the principal driver behind all of this is a shifting in military strategy at the Defense Department that understands today that logistics are probably a bigger part of the equation than they were, say, 10 or 20 years ago. I think that the military planning in the 1990s was there was such overwhelming superiority of force in the United States that any conceived conflict outside of the United States would be over and done with so quickly that logistics really didn't come into the equation. I think that view has shifted, and that logistics now becomes an important part of trying to imagine an extended theater of operations that would be far afield from the United States, and that has woken up some people and many people, the majority, to the fact that having access to dedicated U.S. flag vessels to be able to support military operations is probably a good idea. So we see that as becoming a reality probably this year, and that's going to help expand the U.S. flag tanker fleet, which is a growth area. Talking about growth area in the Jones Act is something that is there's not a lot there. So this is something we think is very encouraging. And it'll help, and it fits into the sort of made in the USA and U.S. Skill sets, developing and maintaining the critical skill sets that we think are important in this industry. So that's how we see it from the tanker side. Dan, on the non-tanker stuff, you guys are very active there.
Yeah, and I'll keep it short because we've got only a little bit of time left, and it's not a core part of my daily activity. But I think it's a very clever public-private partnership, the MSP program. It is an efficient way for the U.S. Defense Department to have access to both the hard assets and the soft skills, the crews, to sustain projecting power over the horizon. And I think, both looking to the Pacific and maybe less predictably, but more immediately to Eastern Europe, sustaining these programs and building on them as they are, as Sam just noted with the tanker security program. I think there's a tailwind there. They are very efficient programs, and I would expect to see continuing support and indeed growth in that space for over the next several years.
Great. So since we are running a little low on time, first of all, let me say, if anybody does have any questions, you know how it works, you can submit it and I'll try to work it in. But now we can finally get to the supply side a little bit, and I'm going to start with you, Greg, because in general, probably everybody watching this knows that there's not been much ordering of of anything really Jones Act lately. But one of the challenges, I think, is that the reason that's the case is returns have not been good. And that's been exacerbated by the fact that the government has just been piling on regulations one after the other. And it's happened for a while, but that could be anything from ballast water to subchapter M to tier 4 engines on towboats. And nobody's being compensated for this extraordinary level of sort of extra expense. You know, you guys are a private equity backed company. How do you think about going out and saying, all right, well, you know, we haven't made good returns generally. The industry hasn't made good returns for a while, and we're being expected to cover all this cost and not being compensated for it. Why should we keep spending money on this business?
Well, it's a great question, and I'm gonna take a little bit of a dry cargo slant here, given our petcoke exposure, and we have actually invested in renewing about a third of our 300 barge fleet at MG over the last 3 years, and so we, you know, because this is a capital-intensive business, we like to invest counter-cyclically and try to buy things when they're less expensive. And so our ability to do that enables us to deliver on our customers' expectations to put young barges in front of their dock and have barges that are frankly more efficient. So we're able to build slightly larger barges, 14 versus 13 foot hulls. And basically we have barges now where 7 can do the work of 8 older barges. So they're inherently more efficient. They take less horsepower to move around, less labor content, less emissions as a result of that, and less interaction from our customers to load them. So that's been a way that we address the reinvestment piece at MG. Now at Andrew, it's really kind of the same. The liquid conundrum that you mentioned which is, you know, it's based on, yes, it's increasing costs and it's trying to struggle to recapture that capital that you have to apply to that, whether it's on existing assets and modernizing them or investing in brand new assets, which I've heard have gone up in the liquid space about 30% over the last 3 years as well, partly due to steel, but partly due to the factors that you just mentioned. So in this environment where there's questions at the margin in terms of sustainability of some refineries, making a long-term investment with a customer who may not be willing or able to make a similar long-term investment in terms of a contract to support that asset is a real challenge. Ultimately, you know, supply and demand will cure that, and capitalism works, and it will resolve itself, as I mentioned earlier. But for now, it's certainly a conundrum.
Yeah, I think I'll add on to that from the larger tanker perspective and larger ATB perspective. I think, Ben, you know that the building capacity in the United States is pretty constrained. The 2 yards that can build tankers right now are quite filled with government contracts. NASSCO is building oilers for the Navy, and Philly Shipyard is building training ships for the maritime academies. And as well, recently, I think got a contract to build some specialized equipment for the emerging offshore wind industry, and that's going to be a factor going forward. The shipyards that are in the United States are going, wind is going to get a lot of wind behind it, I think. And sorry for the pun, but so that's going to make access to shipyards going forward in terms of building new capacity. It's going to make that challenging. So our view is existing capacity is going to have to work for a long time. I think the tanker fleet, many people think the tanker fleet in the Jones Act is quite old. It's not. It's quite young. The vast majority of ships have been built within the last 10 years, and they have a pretty good long life ahead of them. So I think a lot of the work is going to be done I hope in partnership with our charterers or the refineries or the distributors that Greg referred to, in terms of trying to find creative solutions to make a difference in whether it's in emissions or other regulatory hurdles that we're going to have to cross in the coming years. The holy grail right now in terms of the conversation that's going on there is that because the major companies are going to be held to not only Scope 1, but Scope 2 and Scope 3 emission standards, that Scope 2 emission standard is going to mean that whatever the owners' emissions are going to have to be owned by the charterers as well. So they're not going to be able to necessarily just put it on our plate as our problem and our problem alone. It would be nice if it worked that way. It hasn't always worked that way in the past. But certainly the conversations are going on right now. I would say there is more open discussion with our charters and recognizing that this is a problem that needs to be addressed jointly. And I'm hopeful that will lead to some good solutions. But it is more likely, in my opinion, to be in the form of retrofitting and or modifying existing equipment in the short run, let's call it the next 5 to 10 years, while the international market, where there's so many other ships and so many other solutions that are being provided, will probably go through trying to figure out what's the best solution to particularly propulsive power that will result in reduced emissions and trying to get to that net zero goal that is aspirational around the globe. I think that the U.S. market's going to take a little bit of a backseat and watch how that problem is resolved internationally before investing in new equipment, and in the meantime working around the edges to try and get incremental improvement.
I guess just to finish off some thoughts, I'm reminded of a comment Charles Fabricant made fairly frequently, which is when you're shaving in the morning as a ship owner, you're looking at the enemy, which is the issue that we all see rates go up and run to the shipyard. I think in the Jones Act, putting capacity of shipyards aside for a minute, because you can always build an ATB somewhere.
Yes.
Just keep that in mind. There's actually a lot of discipline on the ownership side. So maybe we're less of the enemy than we used to be. And I think that's an important point when you think through controlling supply in this market.
So another, again, maybe addressing the news article that was out the other day, it sort of blamed the Jones Act for being maybe not too environmentally friendly, and Sam, you mentioned the assets are not as old as many people think, but generally speaking, because of the high cost of equipment, people like to keep them around longer, and that means they're less efficient from in this case, a carbon perspective. I don't know. Do you buy into that, or do you think that's not, in fact, the way that things really are? Well, again, we'll start with Greg. We'll go in reverse.
Counterclockwise.
You're right, counterclockwise. I don't know, Greg. Do you think that the U.S. is sort of needlessly behind the curve from an environmental standpoint?
No, I don't think we're needlessly behind the curve from an environmental standpoint. I think, the U.S. benefits from its natural geography of having 12,000 miles of navigable waterways that connect the breadbasket of the U.S. to international markets, and conversely, flows hydrocarbons in the form of intermediates to the great manufacturing that lies along the Ohio River and other great rivers. So, I think the U.S. has taken full advantage of the natural benefit it has by virtue of these waterways, along with the ports and infrastructure that has been built over the last 80 to 100 years to its maximum benefit. And I think it does as well to remember that maritime transportation is not only the most efficient in terms of tons moved per gallon of fuel, but also the best in terms of emissions, the safest mode of surface transportation, and frankly has flexibility that is unparalleled. I mean, you don't get that through a pipeline, or it's just challenging to move, have the flexibility of railroad tracks the way that moving the way that the maritime is. So it's inherently better than other modes. And I think the challenge for all of this is to try to really understand. I think Daniel mentioned this earlier, is to avoid false starts around what the next fuel is going to be that ultimately is going to be sustainable and supported by engine manufacturers and fuel distributors, and will achieve economies of scale. And until we get there, I think it's incumbent on all of us who operate to do the best job we can to operate with a minimal environmental footprint, but maintain the safety and security that the country and our customers have enjoyed for decades.
So just to follow on from Greg, I guess, Ben, if I may, I think he covers it really, really well. A couple of things that come to my mind when you talk about is the US behind on low emission solutions. You got to think fairly carefully about it. I think some of the earliest LNG powered container ships were US Jones Act vessels built in the last several years. So clearly a leader on that front. And a lot of the Jones Act tankers that came out in the last decade are eco ships, and probably on a percentage of fleet basis, we have more eco tonnage in the Jones Act than internationally. That may change over time, but today we're probably ahead. The fundamental point I'll leave you with is all of our trades are short haul, and in comparison to the international trade. So Greg's point on the gallons consumed per delivered barrel, we're the leader. If you're moving gasoline from the Gulf Coast into South Florida or even further north, and you're competing with anything across the Atlantic, you're going to burn 60% less fuel delivering that barrel. That's a big ESG component. So we're well positioned for those sorts of solutions.
Yeah, and I would add to that, if you look at Florida, I think that it's all that Dan and Greg have covered it. But the only real alternative to moving, Florida has a huge consumption base for fuel. It's about 750,000 barrels per day of transportation fuel. It has no refineries and it has no pipelines that serve it. So what's the alternative to getting, fuel into Florida? The best, most ecologically friendly way to do that is short haul on the Jones Act. As Dan said, the carbon, the raw carbon emissions per barrel delivered are always going to be less when measured by the Jones Act vessels. Short haul is the best way. Short haul is the best way to reduce carbon emissions. That's the
punchline.
Right. I am not sure whether we're out of time yet or not. Maybe somebody can send me a message. But
I think we have 3 minutes.
3 minutes. Okay, there we go. Good. That's perfect, because my last question I've been waiting on, and it is on this panel. We have one public company, we have one formerly public company about a year ago at this time, and one private company, private equity backed company. This is not a major major market, right? Let's talk through a second. Why does it make sense to be public or private? And do you think that the industry is trending one way or the other? Whoever wants to take a stab at that.
Well, Dan, you have both sides of the perspective. I think you're the one that goes first.
I think if you look at some of in the Jones Act trades, there's been a lot of cycles which have really, at least on the bigger players in the tanker side where there's a lot of capital at risk, you've seen cycles that have taken us through bankruptcies a number of times. So maybe the private sector can do a better job on the long term. It depends who the private sponsor is, of course. Not all private sponsors are long term. So I'll leave it there.
Yeah, and I would just add that both ownership structures have their puts and takes. But at the end of the day, my take is that the type of shareholder and who the shareholders are, and having alignment around the vision and the long-term commitment to the company is really key. And having the support from the shareholder base is I think a premier part of that equation going forward.
And I guess that's left to me to sort of put the cherry on top of the sundae. I agree with Greg, but both forms have their advantages and disadvantages. I would comment, one of the problems that we face existing in the public markets is there's very little, there are very few comps that are accurate comps. And that gives investors pause from time to time, because we speak to investors and we give them our vision of what we think the markets look like, rates, cost structures, these sorts of things, the economics that drive our business. And they want to go look at other companies and say, well, how do you compare against somebody that's in the same business? And that information is generally not available, because there are very, very few companies that are directly involved in the same businesses that we're in. So that's a challenge to being public, being able to have that sort of comparable transparency to be able to understand one company, whether they're better than another. It would be nice if there were more public companies in the tanker space, but the reality is they're not today.
That is the reality. Well, Nicholas, we're out of time, and I always know when you pop onto my screen that I'm done. But I do want to say thanks for putting this on. I know it's the first time, but I think that this is a really big market that people don't know anything about, and having events like this really do help. If for no one else, they help me to be better educated on how things are going. So I appreciate you doing it and inviting me to take part.
Well, I would like to reciprocate the thanks to you, Ben, and also to everybody, to Sam, Daniel, and Greg, and to everybody. Really, I'm very happy that we have put together, I think, an A+ agenda in terms of topics and panelists, and this panel, of course, is one of the very top ones. So we hope to repeat it, and thank you very much for sharing your very valuable insight. Thank you.
Thanks.
Nice to see you all.